You've probably heard the word fund thrown around constantly. Index funds, mutual funds, hedge funds, ETFs. Everyone's talking about them. But here's the honest truth. Most people have no idea what the actual difference is between them, and they're investing in something they don't fully understand. Here's why that matters. Choose the wrong type of fund, and you could be paying 10 times more in fees than you need to. Or worse, putting your money in something designed for millionaires when a simpler option would make you far more money long term. Today, I'm breaking down all 4 types of funds, what they are, how they work, what they cost, and most importantly, which one is actually right for you. 8 minutes. Let's go. What is a fund? Before we compare anything, let's understand what a fund actually is. Imagine 10 people each have $1,000 to invest. One person could try to manage it alone, but that's stressful and limits what you can buy. Instead, they pool all 10,000 together. Now they can buy a diversified mix of stocks, bonds, and assets that none of them could access individually. Each person owns a proportional share of everything in the pool, and a manager, human or algorithmic, handles the decisions. That's a fund, a collective pool of money invested across multiple assets. The key differences between fund types come down to 4 things: who manages it, how it's traded, what strategy it uses, and how much it costs you. Let's go through each one. Type 1. Index funds. Index funds are the simplest and most recommended option for most investors. And here's why. An index fund doesn't try to beat the market. It simply copies the market. It tracks a specific index, which is a preset list of companies grouped together to represent a section of the economy. The most famous example is the S&P 500, a list of the 500 largest companies in the United States. Apple, Microsoft, Amazon, Nvidia, all in one fund. When you invest in an S&P 500 index fund, you own a tiny slice of all 500 companies simultaneously. If the US economy grows, your investment grows with it. There are indexes for everything. The NASDAQ tracks technology-focused companies. The Dow Jones tracks 30 of the largest established businesses. There are international indexes, emerging market indexes, healthcare indexes, and more. Because no human is actively picking stocks, the fees are incredibly low. Most index funds charge between 0.02 and 0.20% annually. On $10,000 invested, that's $2 to $20 per year. That's it. One important thing to know, index funds are only priced once per day after the market closes. This is called the net asset value. You place an order anytime, but it executes at the end of day price. For long-term investors, this doesn't matter at all. Index funds are ideal for patient, long-term investors who want reliable, low-cost exposure to broad market growth. Warren Buffett himself has said most people would be better off just buying an index fund and leaving it alone. Type 2. Mutual funds. Mutual funds look similar to index funds from the outside. Both pool investor money and spread it across multiple assets. Both are priced once per day at market close. But the key difference is everything happening on the inside. Mutual funds are actively managed. There's a professional fund manager, sometimes an entire team, whose job is to research companies, analyze markets, and make decisions about what to buy and sell. Their goal is to beat the market benchmark, to outperform the index rather than just match it. This sounds appealing. Who wouldn't want a professional trying to maximize their returns? But here's the uncomfortable reality. Study after study shows that the majority of actively managed mutual funds fail to outperform their benchmark index consistently over a 10 to 15-year period. Most don't beat it, and the ones that do rarely repeat the performance year after year. And you pay significantly more for this active management. Mutual fund expense ratios typically range from 0.5 to 1.5% annually. On $10,000, that's $50 to $150 per year, compared to the index fund's $2 to $20. Over 30 years, that fee difference compounded can mean tens of thousands of dollars out of your pocket. That said, mutual funds aren't useless. They can give you targeted exposure to specific sectors, countries, or strategies that may not be easily available through index funds. Some investors want a human hand on the wheel, especially in volatile markets. Just go in with clear eyes about the cost. Before we get into hedge funds and ETFs, quick favor. If this is clearing up the confusion around funds, smash that like button and subscribe for more breakdowns like this. And drop a comment with the word funds below. I'm putting together a one-pager comparing all 4 fund types with real numbers, and I'll send it to everyone who comments. All right, let's keep going. Type 3. Hedge funds. Now we enter completely different territory. Hedge funds are not for regular investors, and by the end of this section, you'll understand exactly why. The name hedge comes from the idea of hedging, reducing risk by taking offsetting positions. But in practice, modern hedge funds are less about safety and more about chasing aggressive returns using complex strategies most people have never heard of. Here's what makes hedge funds different. They use strategies unavailable to regular investors. Short selling, which is betting that a stock will fall in price. Leverage, which means borrowing money to amplify their bets. Derivatives, complex financial instruments that can multiply gains or losses dramatically. And they invest across any asset class imaginable: stocks, bonds, currencies, commodities, real estate, even art. Because these strategies carry enormous risk, hedge funds are only open to accredited investors. In the US, that means individuals with a net worth over $1 million or an annual income above $200,000. These are not everyday investment products. The fees reflect this exclusivity. Hedge funds typically charge what's called a 2 and 20 structure. 2% of your total assets annually, plus 20% of any profits they generate. On a $1 million investment earning 10%, that's $20,000 in management fees, plus $20,000 in performance fees. $40,000 in a single year. For this to be worth it, the hedge fund needs to dramatically outperform what you'd earn elsewhere. Some do. George Soros famously made $1 billion in a single day shorting the British pound in 1992. But most hedge funds don't deliver those results, and many underperform simple index funds after fees. Hedge funds are for ultra-high net worth individuals who can absorb losses, want sophisticated strategies, and have the financial knowledge to evaluate what they're actually buying into. Type 4, ETFs, or exchange-traded funds, are where it gets interesting because they're essentially a hybrid of everything we've discussed. Like index funds, most ETFs track a market index passively, meaning low fees and broad diversification. But like stocks, ETFs trade throughout the day on the stock exchange. You can buy at 9:30 in the morning and sell at 3:59 in the afternoon at whatever the current market price is. This real-time trading gives you flexibility that index mutual funds don't offer. If a major event happens midday and you want to act on it, you can. Index mutual funds force you to wait until the end of the day. Fees for most ETFs range from 0.03 to 0.75% depending on the type. Basic broad market ETFs are incredibly cheap, sometimes even cheaper than their mutual fund equivalents. There are now 2 types of ETFs. Passive index ETFs that simply track a benchmark, and actively managed ETFs, where a fund manager is making stock selections, similar to a mutual fund but wrapped in the ETF trading structure. Actively managed ETFs tend to cost more, but still less than traditional mutual funds in most cases. Another unique advantage of ETFs is tax efficiency. When mutual fund investors redeem shares, the fund may need to sell underlying securities and distribute capital gains to all shareholders, including you, even if you didn't sell. ETFs avoid this through a mechanism that allows shares to be exchanged without triggering taxable events. In a regular taxable account, this can save you meaningful money over time. Popular ETF providers include Vanguard with VTI and VOO, iShares with IVV, and State Street with SPY, one of the most traded ETFs in the world. Let's put all 4 side by side so you can see the full picture. Index funds. Passively managed, priced once daily, extremely low fees between 0.02 and 0.20%. designed for long-term investors who want reliable market returns with minimal effort and cost. Mutual funds, actively managed, priced once daily, higher fees between 0.5 and 1.5%. Best for investors who want professional stock selection in specific sectors and are willing to pay for the possibility of outperformance. Hedge funds, aggressively managed with complex strategies, available only to accredited investors, fees of 2 and 20 structure, designed for ultra-wealthy investors seeking maximum returns with full understanding of elevated risk. ETFs, mostly passively managed but actively managed options exist, trades throughout the day like a stock, low fees between 0.03 and 0.75%, offers flexibility and tax efficiency alongside broad diversification. Which one is right for you? Here's the simple decision framework. If you're just starting out or building long-term wealth with minimal effort, index funds or ETFs are your best options. Low cost, simple, historically reliable. You'll outperform most active managers simply by staying invested and keeping fees low. If you believe in a specific investment strategy or want targeted sector exposure and you've done your homework on the fund manager's track record, mutual funds can play a role. Just keep them to a smaller portion of your portfolio and watch those fees carefully. If you're a high net worth investor, a sophisticated institutional client, or managing a large portfolio that requires complex risk management strategies, hedge funds deserve exploration. Otherwise, they're not for you. The core principle? Costs compound just like returns do. Every percentage point you pay in fees is a percentage point you don't keep. Over 30 years, the difference between a 0.03% ETF and a 1% mutual fund on a $50,000 investment can exceed $100,000. Bottom line is index funds give you the market passively and cheaply. Mutual funds give you active management at a higher cost with mixed results. Hedge funds offer aggressive strategies reserved for the wealthy. ETFs give you the best of index investing with stock-like flexibility and tax efficiency. If this finally made funds make sense, subscribe for more investing breakdowns, hit that like button, and share this with anyone still confused about where to put their money. And don't forget to comment the word funds below so I can send you the one-pager comparison. See you in the next one.